Hello everyone, welcome back to Shellcode AI driven share trading channel. This is phase 1, absolute beginner, model number 1 and topic understanding demand and supply, the order book and the bid ask spread. To begin with, let's start. So I want to start with a question. You ever watch a stock like you are checking your app and the price just drops? For no reason you can see, right? The company is doing fine, no bad news, nothing, and you are just sitting there like, what is happening? Or the opposite, a company posts amazing profit, record breaking numbers, and the stock goes down. That's make zero sense, right? Except it actually does make perfect sense. And once I explain it to you, you are gonna look at the market completely differently. Today, we are covering three things: supply and demand, the order book, and the bid ask spread. These are the actual mechanics behind every price move you have seen. No theories, no prediction, just how it literally works. Let's go. I hope you're seeing my screen. Right. So here's the thing. A stock price is set by a company. It's not set by bank or the government or some algorithm in the basement somewhere. It's set by people. Specifically, how many people want to buy versus how many people want to sell. That's it. That's the whole thing. More buyer than seller, price goes up. More seller than buyers, price goes down. I know that sounds almost too simple, but stick with me. Think about sneakers, like a limited drop, 500 pairs maybe, but 2000, 20,000, let's say, people want them. What happens? Resale prices go insane. People are paying double, triple because demand is crushing supply, right? Now imagine the same sneakers gets a bad review next day. Everyone who bought a pair is now trying to sell them, but nobody wants them anymore. Prices collapse, right? Stocks are literally the same thing every day. So when you see a stock price jumping around, you are actually seeing thousands of people changing their mind in real time about whether you want to buy or sell. And what changing their mind? Lots of things. For example, goods earning come out, suddenly everyone wants in, demand shoots up, price goes up. Let's say CEO gets caught in scandal, everyone's rushing to the for the exit, supply floods the market, price crashes. For example, a famous investor tweets about a company, suddenly retail traders pile in, demand spikes overnight. Another example is interest rate go up. People start pulling money out of the stock and into safer stuff. Less demand across the board. Every single one of these things is just tipping this scale between buyer and seller. That's the foundation. Everything else we are gonna talk about is just the mechanics, how that plays out, right? So that's demand and supply. Moving to the part 2, how prices move in real time. Okay, so now you understand why prices move. Let's talk about how they physically move, because this part trips people up. A lot of people think there's a price tag on the stock, like it's fixed at 150 rupees and then someone just change it to 148, for example, right? That's not how it works. Here's what actually happening. Every time someone wants to buy or sell a stock, right, they send an order to the exchange. The point number one that is there. Okay. And they send an order to the exchange, and the exchange has the insanely fast computer called a machine engine, matching engine. So those entire job is to pair buyer with sellers. Point number two, simple. When a buyer and seller agree on a price and a trade happens, the transaction price becomes the new price of the stock. That's what shows up on your screen. So the stock price is not set by anyone. It's discovered through constant real-time trading, right? Here's what a price drop actually looks like in practical. So imagine a wave of people suddenly want to sell a stock, a lot of them at the same time, right? They started submitting sale order, but there are not enough buyer at the current price to observe all of them. So what do sellers do? They start lowering their price to attract buyers. Then the next seller lowers it a little more, then a little more. Each trade that gets executed is at a slightly lower price than the last. And that's what shows up on your chart as the red candle going down. It's not random, it's not magic. It's just a lot of people adjusting their prices until someone says, yeah, okay, I'll buy it at that certain price. Pretty wild when you actually see it that way, right? So that's the price update. Correct? Let's go to the next topic, the order book, the hidden engine. All right, this is my favorite part because most videos skip this or make it super confusing. I'm gonna make it that simple. The book is just a list, two lists actually, right? Buyer, which is bidder, and seller is asking, right? Ask, you can see on the screen. One side buyer, everyone who wants to buy the stock and the maximum price they are willing to pay. This is called a bid. The other side, right side, seller, everyone who wants to sell and the minimum price they will accept. This is called ask. And let me highlight it here, you see. And they are sorted by price, best prices at the top of each side. Let me give you a real example. Say you have got buyer willing to pay 150 rupees, 149 rupees 50 paisa, 149 rupees 50 paisa going down. 150, 149, 148, let's say, going down. And seller willing to accept uh, uh, 151, 152, 153 going up. The best buyer is at 149, right? The best seller is the 153, the higher price. They have not agreed yet. There is a gap, right? There is a gap of some rupees. We'll talk about that gap in a second. Now, here's where it gets interesting. Imagine a big hedge fund suddenly needs to buy 5,000 shares right now. Correct? The point number key highlights this one. And they don't want to wait around. They hit what's called a market order, basically saying, give me share at whatever price is available. So they sweep through the orders book. They buy the 300 share at 150, then 800 share and 151, and then they need more, so they go up to around 152, 153, 154. With each level they eat through, the price goes up, the stock moved just because of that one order. That's called price impact. And it's why you will sometimes see a stock spike for no obvious reason. Someone big just need a share fast. Flip it around, right? A big seller dumps a ton of shares fast, sweeps through the bids, and price falls. Same idea, right? So, and when you hear people talk about thin market and low liquidity, that just means the order book is nearly empty. Not many orders on either side. So even a pretty normal size trade can move the price a lot. Thick order book, hard to move the price. thin order book, one trade can send it flying. Are you getting my point? So this is very interesting. Let's move to the next one. And this is the bid ask spread, the invisible cost. Okay, so last piece, and this one is uh, going to save you actual money. Remember that gap up I mentioned before, the best buyer and the best seller, right? So example, the bid is 150 rupees 90 paisa, ask is 150 rupees. The gap is 0.10, right? That's the difference. It is called the bid ask spread. And here's you need to care about it. When you buy a stock, you pay the ask, right? 150. If you turn around immediately and try to sell it, you will get bid 149.90 paisa. Are you getting my point? So you just lost 10 cents a share before the stock even moved, right? Or 100 share, that's 0.1 rupee. On 1000 shares, that's 100 rupees gone instantly. It does not sound like much, but if you are trading frequently, it's add up fast, really fast. So who is collecting that spread? Market makers. These are companies, usually big banks or specialized firms. Those job is always be ready to buy and sell. They post bids and ask constantly. When someone buy from them, they sell it at the ask. When someone sell to them, they buy it at the bid. They pocket the difference, right? They pocket the difference. In exchange, they are providing liquidity, right? Meaning you can buy or sell pretty much any stock and at any time without having to wait around for someone to take the order or take the other side of your trade. It it's actually a pretty elegant system, but it does cost you. Now here's the practical bit. Spreads vary a lot depending on stock. So here are some examples. Apple, Tesla. You are looking at a penny spread, maybe 2 cents, super liquid, tons of trade, easy to get in and out. Some small company nobody's heard of, this spread might be 50 cents, a dollar sometimes or more, right? Because there are not many buyer and sellers. So market makers charge more to take the risk. Before you trade any stock, especially a small one, check the spread. It's not showing prominent on most apps, but it matters. It's cost you like commission, except nobody talks about it, right? So, what are key takeaways from today's videos is let's lend this three things to walk away with. One, supply and demand. Every price change, every single one, is just the market trying to find a price where buyer and seller agree. News, earning, rumors, they all just shift that balance, right? The order book, it's a live, constantly updating list of everyone who wants to buy or sell. Large orders sweep through it and move prices. Thin orders mean more volatility, right? Bid ask spread, you buy at the ask, you sell at the bid. The difference is the hidden cost on every trade. Bigger in small stocks, always worth checking. Honestly, most retail traders just look at charts, hope for the best. Understanding these three um, mechanics puts you in a completely different league. If you clicked, if this clicked for you, hit subscribe. I drop these every week, and drop a comment. I'm curious, uh, did the order book thing make sense, or do you want me to go deeper on that? Next video we are getting into market order versus limited orders, and specifically by hitting buy or a fast moving stock without understanding this can cost you way more than you expect, right? Right. All right. So this is all about today's video, and till then, happy learning. See you soon. Thank you.